All right, we are live on Instagram and we look to be live everywhere else now as well. Beautiful. All right, guys, it is Larry MF White here, and I am so thrilled to have not just a good friend, a good mentor of mine, but a chief economist that is known throughout the world, Rick Sharga. How are you doing today, sir?
I'm doing okay. We're keeping warm here in rainy Southern California, but all the family's all healthy and safe right now, so I can't complain. We're doing okay.
Hey, that's what right. Like everything that we've been preaching to our agents and the people that I talk with is like safety first, right? Like safety first. Then how do we keep business going? And then how do we fill the pipeline for whenever this comes? Because this too will come to an end. But before we get into that, let me just kind of let people know that aren't familiar with you. So you are the CEO and founder of CJ Patrick Company, which is a consulting company primarily focused on real estate, financial investment, technology, basically to allow them to create competitive advantages in their business strategy. Would that be correct?
Yeah, we focus a lot on business strategy, business models, marketing strategy, and for some companies, I give them some media support too, since I've been involved with the media for decades.
Absolutely. You bring over 25 years of experience. We connected on a couple of different companies that we were both associated with. I know that you're executive vice president over at Carrington Mortgage Holdings. You've been the chief marketing officer for 10X, which was formerly known as auction.com. You've worked for Realty Track at a senior level executive position. I mean, you're literally, in my eyes, like one of the most frequently quoted real estate professionals, because you've been on, everything from Bloomberg to CNN to ABC to NBC, like every major news source that I can think of, like you're being quoted on a daily, weekly, monthly basis. And I know even on Inman News, you were ranked as one of the top 100 most influential people in real estate. Bravo on your tenure here in real estate, sir.
Yeah, and it's been an accidental journey too, Larry. I spent the first half of my career doing marketing for technology companies. After the dot-com bubble burst, I actually got into consulting for a little while and took on Realty Track as a client. And I came on board full-time with what was supposed to be a limited engagement when the foreclosure crisis hit. And we were the only company with a national database of foreclosure information who was willing to talk to the press. And so for probably 5 or 6 years, I literally was the most quoted person in the country on real estate foreclosures and mortgages, and have kept those relationships alive over the years. And I still am a very active industry observer. And for any of your viewers today who are interested, I'm posting regularly on LinkedIn and Twitter. Real easy to find, but if they're interested in real estate, mortgage, technology that's related to those markets, I'm out posting on those things all the time.
And they can just search you, Rick Sharga. Is that your handle on both of those?
Yeah, I try and keep it real simple so I don't forget where to find me. But yeah, it's Rick Sharga is the Twitter handle, and that same name on LinkedIn. I have aliases, but I can't tell you where I'd have to kill
you. Very cool. Well, man, we are in such in an odd time, a different time. I don't even know what word that I want to use here. I know I have never seen this before. I don't think as an industry we've ever seen this before. So let's just start with like a state of the union. Like, how in the hell did we get here, Rick?
Well, we got here internationally, and somebody brought a virus along with them on an airplane is how we got here. The reality is, and I've been doing some research on this. I'm about to set out a research report talking about the housing market and how it's gotten through prior pandemics, which we can talk about a little bit if you're interested. But bottom line is, we probably weren't going to be looking at a tremendous year in terms of home sales. we were going to probably be looking at a year over year flat rate of sales compared to last year. Not because the underlying fundamentals were bad, but because there wasn't anything to buy. Inventory levels were still way off where they should have been, but we were creating jobs. The unemployment rate was at a 50-year low. Wages were going up, and wages were actually going up faster than home prices for the first time in a decade or more. Interest rates were low. So and household formation was increasing. So all the conditions were in place to have a really good year in terms of home sales, other than the fact that inventory was lagging a little bit. And I think ultimately that would have taken care of itself. Nobody can predict a black swan event like a global pandemic.
Right.
And nobody could have predicted. I mean, we've had two pandemics in the 2000s already. We had the swine flu and we had SARS.
Yeah.
Neither of them managed to shut down the global economy.
Right.
This one has, and this is unprecedented. Even if you go back to the terrorist attacks at 9/11, that did shut down the economy, but only for a very brief period of time.
Right.
And if you look at these kind of statistics and you look at unemployment filings, we've had 10 million first-time jobless claims in the last 2 weeks.
That is crazy.
The chart kind of goes like this historically and then goes straight up. It's like a 90-degree angle. We've never had nearly this. I think the 6.6 million filings we had last week was 10 times the previous high number for a given week. Now, I tend to be more optimistic than I probably should be.
Okay.
But my view on this is, while the unemployment numbers are scary, we should have expected that because everybody's been told to stay home.
Yeah.
And a lot of companies just are furloughing people, not necessarily laying them off, but saying you don't have a job today, but as soon as this thing is over, you have a job, come back.
Sure.
Big employers like Disney here in Southern California and Florida, paying their workers through April 18th. So they've been paying them for a month and a half to basically stay home.
Yeah.
They're going to furlough them after April 18th with the hopes that sometime in May they'll be bringing them all back. So it's trying times, and we can look at what's been going on in some other countries that did the shutdown ahead of us, and use that as sort of a predictive measure. Good news is the countries tended to bounce back relatively quickly, and our hope here is that everything was going well enough that once everybody's allowed to get out of the house again, things will restart relatively smoothly.
Yeah. Now, so I think I even heard you predict, and like in the past on some of your articles and stuff, like there's nothing that, like, there's no signs of the market kind of slowing or anything else unless there's a pandemic. Like, you had something really close to that, right?
For the last 2 years, well, you and I have both worked with people who either look for foreclosed properties,
Sure,
invest in them, or businesses that basically are in default servicing. And so I get the question a lot: when's the next wave of foreclosures? And I've been debunking a lot of foreclosures are coming myths over the last few years because I just didn't see it. And you're right. Basically, my mantra for the last few years was, the only thing that can lead to an increase in foreclosures is another recession. And short of some sort of global catastrophe, I don't see a recession, anywhere in the future, near future. And of course, careful what you ask for. But that's what we're seeing right now. We're almost certainly in a recession right now. The numbers haven't come out. And in a country like ours, where 70% of the gross domestic product is consumer spending, when you send consumers home and don't give them a job, and then don't give them anything they can buy, that's gonna hit the economy pretty hard. But again, the hope from all of us watching this is that it's a short, strong recovery period after the pandemic kind of peaks and we get this thing under control.
And so, based on like what you've been studying with other countries and stuff, right? Because maybe 4 weeks into this self-quarantine at this point in time.
Right.
Like, what are other countries seeing that have kind of been through this already? Like, how long are people staying in this kind of shutdown mode?
Well, the shutdowns vary, and that depends on the severity within a given area. What what I'm reading now, and I am not an expert on epidemics or medicine, so take this all with a grain of salt. But you kind of move from a mass quarantine or shelter in place environment where you're trying to mitigate the flow, the spread of the virus, to a point where you can start to identify pockets or even individuals and do containment so that the rest of the economy kind of keeps working. We couldn't do what China did, for example, because we don't like martial law. And ordering everybody to stay home at gunpoint probably isn't really part of our DNA.
Sure.
So our curve, number of people getting the disease, looks a lot higher short term, but the CDC folks have basically been saying now for a couple of days that we may peak sooner than we thought. That the number of deaths may be a lot lower than projected by some of the initial models. And I think you move from that broad mitigation to containment and control, and you get back to something closer to normal relatively quickly. The key to all this, of course, at some point is having a vaccine available.
Sure.
And everybody gets their shot and you go back to pretty much life as we used to know it. Although there's a lot of discussion now about whether we should ever shake hands again, because it's gross and barbaric, as the president once said. But I do want to point out, if you look at getting to real estate specifically, if you look at what happened in Hong Kong and you look at what happened in China, once the lockdown was in place, transaction activity plummeted. I mean, it virtually stopped.
Sure.
Now, China's numbers are a little misleading because the virus hit there right around the time of the Chinese New Year. And transaction activity in China always stops around that time. It's like our seasonality here.
Sure.
But it didn't recover because of the virus. Now, once they were let back out of their houses, and same thing happened in Hong Kong, you started to see really pretty rapid uptick in transaction activity. So the hope is that we'll see the same sort of thing here, but a lot of it, as always, comes down to jobs. So the real questions are, how many companies survive this and are able to restart once the pandemic is declared, over enough that you can go back to work? And of the ones that start, how many jobs do they make available for those people that were laid off?
So that was one of the questions that I had just wrote down while we were talking here, was the fact. So right now we're figuring out different ways to do business, right? We've never been forced to do business this way. So we're being forced to manipulate, adapt, change, which in my eyes is bringing about some efficiencies, because like you look at real estate specifically, it's essentially been done the same way for the last 100 years. In New York, it literally takes 8 people to sit down at a table in order to close a deal, right? You have a buyer, a seller, a buyer's agent, a seller agent, a buyer attorney, a seller's attorney, an escrow officer, right? And now that has to, now on the West Coast, we don't have that. We've already kind of adapted, but I think it will force some others that have kind of done things traditionally. Do you think companies will become efficient enough to where they won't bring back all of the jobs because they're finding that they can operate more efficient, more productive, with less people at the end of the day?
I don't think you'll see business practices change overnight, because people are creatures of habit. And I still believe often that inertia is the strongest force in the universe. Do I think we'll see long-term changes? Absolutely. I've been looking at the commercial real estate market, which I know isn't necessarily your area of focus, but I think we're going to see definite winners and losers in sectors of the commercial market, because I do think you'll see business practices change, if not immediately, then in the short term. So for example, I think the industrial sector will see another mini boom, because what we've seen is that as e-commerce has become more a necessity than a choice, there are some weak spots in warehousing and distribution across the country that I think will be alleviated. So I think you'll see a mini boom in those kind of activities. cloud computing becomes more important as people are doing everything online. So you'll see more of those facilities go up. On the other hand, I think it's going to take a long time for the hotel sector to recover.
Yeah.
Because I'm not sure people are going to be comfortable traveling even when the pandemic is declared over.
Yeah, or sporting, like national events, sporting events, right? Like things to that nature.
I think the retail sector, there were already a lot of weak retail companies around. So if your investor base is looking for different types of opportunities, there are probably going to be a lot of small retail outlets that are available for a good price. And even prior to this, we saw a lot of retail establishments being repurposed into multi-use facilities.
Yeah,
and doing pretty well. So, but where it comes to your question, Larry, I think the office environment is really the one that I see long-term changes in. If you're a company who sent all your employees home and you're still getting almost everything done that you did before, you have to think about whether or not it makes sense to have a really expensive overhead environment and force everybody to come into the same place all the time, or if we can't do more telecommuting and more working from home and reduce operating costs. So, will it happen to real estate? Real estate's always a laggard when it comes to changes.
sure.
And you are dealing in a market that's fraught with emotion, both from a seller perspective who wants that hand holding and a buyer perspective. I'm moving my family into a house. I want to see the house. I want to see the neighborhood. I want to get a feel for the place. So there's a human element that I don't think we ever completely eliminate. But yeah, eventually I think what we're seeing right now will lead to more efficiencies and more business opportunities that have sprung up from the necessity of changing the way we do business.
Okay, I appreciate that. And so let's talk a little bit about, we have 10 million people that have claimed unemployment at this point in time.
Yep.
So when it talks to housing, what are their options right now? Like, there's talks. I mean, we got into it a little bit when I asked you if you had a few minutes, right, for an interview, like the forbearance agreements alone, right?
Yep.
Like literally, Fannie, Freddie, Ginnie, any government-backed loan at this point has basically said, look, like verbally, we'll provide a forbearance agreement, 3, 6, 9, up to 12 months. Like, what are let's start with the pros. Like, how does that help the economy and the situation that we're in right now?
So I saw an economist the other day who was quoted in either the New York Times or the Wall Street Journal predicting that we were going to see 15 million foreclosures. If I weren't reluctant to travel right now, I would have gotten on a plane, flown to the East Coast, and punched him in the face. Just completely irresponsible. That means roughly a third of the people with mortgages would lose their homes to foreclosure.
Yeah.
We wouldn't be talking about the Great Depression. We would be talking about a smoking box of rubble where the United States used to be if we ever got to that point. That, by the way, that would mean that not only the 10 million people who filed for unemployment, but another 50% would all be losing their homes at the same time. So, not going to happen. Just if we had to buy everybody's mortgage, the government that they would do that first. So, and to put that in perspective, during the entire Great Recession, 6 million people lost their home to foreclosure. So they're talking about 2.5 more times people losing.
Wow.
So again, ain't going to happen. But the government has put in place programs to prevent people losing their homes or being evicted from their homes while they're out of work. So it's a temporary fix. It's important to know, and I think this is really smart because I do think it's much better to address a problem like this by keeping people out of default than it is to try and address it after they've defaulted in the first place.
Which was kind of like what happened in
what happened last time.
7 and 8, yeah.
And the market conditions were very different. This is kind of important too. The market was overbuilt. The builders had not stopped building because of the housing boom. They thought it was going to last forever. Sure. So there was way too much inventory. The properties were grossly overvalued because everybody was a flipper at that point. If you remember, everybody was going to be the next real estate tycoon. Borrowers who had no business getting a loan were being given not just a loan, but 2 or 3 loans. And once the thing tipped over a little bit, there was just no way to fix it. In this case, we had an undersupply of properties. properties actually were more affordable than most people think based on wages and interest rates.
Mhm.
And the borrowers who had these loans were very well qualified. It was hard to get a loan for a number of years.
Right.
Um, so by keeping those people out of foreclosure, keeping them from defaulting, and once they default, there are contractual things and legal procedures that you almost can't stop very easily.
Sure. Like once the train leaves the tracks,
It's really hard to get it back.
yeah.
So I think keeping them out of foreclosure made a lot of sense. The government can only control government loans. So you mentioned there are loans owned by the government, by Fannie Mae and Freddie Mac. There's loans that are insured by government entities, the FHA, the Veterans Administration, USDA. Collectively, they account for about 60% of all mortgages.
Uh-huh.
So those borrowers are given the option of reaching out to their mortgage servicer, claiming that they have their finances impacted by COVID-19, and they're to be given a 180-day forbearance. Important to note the distinction between forbearance and debt forgiveness, because some people get the wrong idea. The debts are not being forgiven; they are being deferred.
Okay.
So, and there are three ways that people can be asked to pay those back. Either they can be asked for a balloon payment, lump sum, which won't work for most borrowers because if you're out of work for 6 months and deferring payments, you're not going to be able to save up enough money for those 6 months.
Sure.
They can be tacked on to the end of the loan, which will probably be the most likely scenario. So your loan gets extended by 6 months from when it was supposed to end, or you can take those 6 months and amortize them over the balance of the loan. So your monthly payments go up a tick, but probably not that much the way that these loans are set up. So this should keep a lot of people out of foreclosure.
Okay.
It should give them enough time, hopefully, not just to get through the end of the pandemic, but give them a couple months of running room to get another job once the economy restarts. And even at that point, if they need more time, they can ask for another 180 days. What I've been emphasizing to people is that if they need the help, they should absolutely not hesitate to go get the help. This program can save a lot of people a lot of heartache. And if people are, in trouble financially, they really need to go take advantage of this. On the other hand, if you don't need it, if you really can pay your mortgage, pay your mortgage.
Yeah.
Don't blame the system.
So that was my next question. So we have 10 million people that are unemployment that may potentially need this. Now, they may not all be homeowners at this point in time, right? So that's not 10 million loans. But let's say, we have a huge portion of loans that go through this. How does that affect the mortgage industry, right? Because there's other companies that are affected by you or I not paying a mortgage payment at this point. So what are the negative sides, like not just for folks, and we talked a little bit about coming up with that lump payment, but what does that do to the economy, like the mortgage, the banks, et cetera, that are providing these loans?
Yeah, remember that pile of smoking rubble I talked about a few minutes ago? Yeah. So the good news is so far, we're not seeing a huge number of loan payments being missed. Now we passed April 1st when mortgages technically are due, but your audience probably knows that a mortgage really isn't late until the 16th of the month.
Sure.
So we really don't know how many people are not making their April payment. We only noticed, by the way, in terms of rent payments, on average, about 20% of people are late with their rent payment first of the month.
Yeah.
This month, it was close to 30%, but it wasn't a huge swing.
Yeah. I have about 25 doors in Cleveland, Ohio. Again, not that much difference this month. Like, I'm interested to see what happens next month. And we are even thinking, like, do we offer an incentive? Like, look, if everybody is current in April, we'll do May for half price, or like we're thinking of incentives like that to, help people out, but ensure that, we're still like looking out for our investment at the end of the day.
Yeah, we should probably talk a little bit about rental programs as well as we get into this, and landlords being vulnerable as we go forward. But and by the way, it's viewed importantly enough that same government program that applies to owner occupants also applies to investors who own properties with government-backed loans. So as an investor, I don't believe you can get the full 180 days, but I believe there's a 90-day program that investors can qualify for. And you should check if your loan is backed by Fannie or Freddie or FHA. Check with your servicer to see what kind of programs are available as well. The quid pro quo here, of course, is that if you're given forbearance on your loan, you're expected to pass that same courtesy along to your tenants, and not, again, not game the system. So we were talking about what could happen in the mortgage industry. Mr. Cooper, who's the largest independent mortgage servicing company, went on record at 2 days ago saying they'd already given 86,000 borrowers forbearance, or they were in discussions with 86,000 borrowers already about forbearance issues. The FHFA, who is the conservator of Fannie and Freddie, noted that about 2% of their borrowers had reached out one way or the other about forbearance programs. The numbers are really important to watch, because when you're talking about 48, 50 million active mortgages, what most people don't realize is the mortgage servicer, the company that sends you your mortgage bill every month, is contractually required to make payments on your loan to the people that own the loan, whether you make payments or not.
Right.
The government did not put any stipulations into its program to compensate the servicers for the payments they need to make to the people that own the loans. My back of the envelope math said that if 25% of borrowers opted into the forbearance program of 50 million loans, and the average loan payment across the country is about $1,200 a month.
Okay.
If 25% of the people opted in after 6 months, the servicers would have had to have paid out about $60 billion.
Wow.
There's not $60 billion laying around in the mortgage servicers' bank accounts. So we're going from an environment where 0.5% of borrowers were in foreclosure, which is about half of the historic average, and about 3% were delinquent, to a market where I don't know how high is up, but if it's 25%, you can't possibly have set aside enough cash to make the difference in payments on 0.5% to 25%. Nobody can predict that.
Sure.
So it's really important that there's some sort of liquidity facility, which is a fancy way of saying a pile of cash, that the servicers can borrow to advance those payments until they get to a point where the borrowers are starting to make their payments again. So it sounds like a bailout. It's really not. It's a short-term loan program.
Okay.
And I think it really is incumbent on the government, who has just made it possible for almost 60% of borrowers to not make payments.
Yeah.
Make sure they protect the infrastructure that could go completely sideways.
Yeah.
You could theoretically start to see some smaller servicers going out of business as early as May, if that's the case.
Yeah. Yeah. Because they just don't have the reserves on hand.
No, and Director Calabria kind of cavalierly suggested yesterday in an interview that, well, if the small servicers can't handle it, we'll just transfer servicing to big servicers. I can tell you, having lived through this myself, loan transfers are no fun for anybody.
Right.
Certainly not for the borrower who's trying to figure out who to make what payment to when, who might be in the middle of a forbearance negotiation and has to start all over again.
Yeah.
Maybe declared in default before they get the forbearance because the loan was somewhere in limbo. And honestly, the kind of loans we're talking about moving, what big servicer in their right mind would take a pool of loans where they have almost unlimited liability because they don't know how many more payments they're going to have to advance, and the borrower is somebody who's out of work?
Yeah.
Not a really good risk profile from my perspective if I'm taking on loans. So I think there's a fundamental, this is kind of scary to say about the guy who runs Fannie and Freddie, but it seems like there's a fundamental lack of understanding about how the mortgage system works. And I'm hoping that too many people don't game the system, and B, that somebody comes to their senses and we have a credit facility available for the servicers.
Right. Yeah. So it sounds like, right now, we're addressing the needs of the average consumer and stuff, but we don't have anything in place for the back end, which is what keeps this all running at the end of the day, if I'm hearing.
And to be clear, coming out of the last recession, anytime you talk about making money available for banks or anybody in the mortgage industry, you're going to get some backlash from people who just think the banks are evil. But bottom line is this financial infrastructure is what makes it possible for people to buy and own houses.
Sure.
And if you crater that, you're going to make it really, really difficult for the next home buyer to even get a loan, much less get a loan at favorable terms. So it's kind of a mutual dependency that people have to recognize.
Absolutely. So, we touch on this briefly, but, we both come from the default space, carrying 2,000 plus foreclosures at a time in some cases, right, across the country. When I know a lot of agents that, we're affiliated with or associated with, like this was one of the most profitable times because they were these big foreclosure agents. So we have a lot of people that are asking like, is there going to be a new foreclosure wave, et cetera? So people stop making their payments, right? They may or may not have a job at the end of that forbearance agreement. They may or may not be able to, work out a loan modification or something if they still don't have something in place. And there's a lot of unknowns and variables, but a year and a half, do you forecast like an uptick? Maybe not like, obviously not like we were in 2007 or 8, but could this potentially cause like that next short-term REO foreclosure type market?
I think everybody's going to lose their home to foreclosure. We should just probably wrap it up and go home. No, all kidding aside, I think it's inevitable when you go through an economic downturn like this that there will be an uptick in defaults and in foreclosure activity. I think that is inevitable. And by the way, we didn't talk about the other 40% of borrowers who don't have a government-backed loan. Now, some of the bigger lenders have announced that they would do similar forbearance programs. And candidly, some of the proprietary loan modification programs, the non-governmental ones during the last crisis, were better than the government programs. So it's possible we'll see that. But yes, we will have higher unemployment coming out of this downturn than we had going into it.
Yeah.
The economy will not recover instantly and go back to the same levels that it was. So some people will lose their homes. Now, what I don't know, and I haven't seen any studies on this yet, is what the ownership versus rentership of the people affected with job loss actually is. So clearly the industry is affected: travel, tourism, hospitality, restaurants, retail, not the highest paid parts of society. Home ownership rates among lower income households tend to be lower than upper income households. So I don't know how many of those people actually owned homes and are running the risk of losing them, but there will be some. What anybody in the space who's looking at default servicing or looking at investing in or selling foreclosure properties needs to keep in mind is the timing. So on the government side of things, you're really looking at a year conceivably before anybody even goes into default.
Yeah.
Because you have the 280-day forbearance periods.
Sure.
There are regulations put in place during the last crisis that limit your ability to start the foreclosure proceedings once somebody misses payments. So figure it's a year plus 90 to 120 days, depending on what state you're in, before somebody's actually even technically in default. So that's a year and a quarter.
Yeah.
Then you go through the foreclosure process.
Sure.
In most states will take at least a year because of the regulations put in place. And God bless you if you're in New York or Florida or Illinois, it could take you, a decade.
We ran through that. I mean, just some of the differences: East Coast versus West Coast. West Coast, it's 6 months, like 3 months you're out with payments, 3 months of the foreclosure process, and the bank has it back. New York, we're talking 4 to 5 years in some cases before the banks are getting these properties back.
I think it peaked at 1,400 days, but I still talk to investors who have properties they've owned for 10 years, and the people are fighting foreclosure and haven't made a payment for since 2000,
Wow.
or 2010. But so if you're looking for some of that inventory to start getting to market, my point is it's probably going to be a year and a half before the foreclosure proceedings really start.
Uh-huh.
And it'll be a few months longer until you start to see some of that stuff work through the system. And what becomes available as REO depends on where the economy is at that point.
Sure.
What we've been seeing for the last couple of years is that in a low inventory market where you had high demand, a lot of those properties never made it to REO.
Right.
So you had either investors or home buyers buying the properties as soon as the homeowner became distressed. Before even the foreclosure auction happened, you had a higher number of people going to foreclosure auctions and buying the properties at the courthouse steps or the sheriff's sale than you had in prior years. And then a small percentage got back to the banks as REO.
Yeah.
So, again, if we have an uptick, it probably won't be noticeable for a year and a half.
Yeah.
And there's no guarantee that a lot of that inventory ever makes it back to the banks. Now, that's suggesting there's not another massive downturn and that the economy does start to recover. If things go sideways after the pandemic, we could see a faster, more significant influx of foreclosures.
And so let me just wrap up with this question here. As we're talking, a lot of those don't make it because we've had this new wave of hedge funds, REITs, et cetera, that are pulling these properties. They're buying them directly, these default loans and people non-performing notes as well, right? And so they're never making it to the foreclosure REO process. I've noticed because I run, I coach and train on Real Estate Pro, where we're working with institutional buyers, right? These hedge funds, REITs, and 90% of them have paused. They're like, hold on, guys. We don't really know what's going on. We don't know how to underwrite these properties. We want to buy. We just don't know how to buy right now because we don't want to buy something in the market. So they're pausing. I view them as smarter than I am in most cases, right? And so I kind of followed suit of okay, well, if you guys aren't buying, I'm going to hold off right now. Do we see a fluctuation in market prices at all?
That's a great question. What I can tell you from having just dug through 20 years of data from First American Data Tree is that after prior pandemics and after 9/11, the only one of those times we saw any price depreciation was after 9/11. And that was a very minor dip for 1 month.
Okay.
Prices came back the month after that and never looked back. Now, you do see transaction volume soften a little bit coming out of these pandemics or coming out of recessions. But home prices are surprisingly resilient through those time periods. And in fact, in every recession since World War II, except the last one, home prices the housing market actually helped pull the economy out of the recession.
Okay.
What was different about the last one is the housing market took us into the recession. So the recovery didn't behave nearly the same as it has prior to that. But pricing, unless you're in a particularly heavily impacted individual market, pricing usually recovers pretty well and definitely recovers faster than transaction volume. I'd say something else for investors. The investors I know who are buy and hold rental investors historically have been a little less price sensitive than flippers.
Sure.
Because you're making your money off cash flow and your monthly return rather than home price appreciation.
Right.
So I don't know that I've seen data yet that suggests we've seen a huge fall off in rental purchase buyers. But the fix and flip market is definitely seized up a little bit. We've seen all of the iBuyers, Opendoor, OfferPad, Zillow Offers, Redfin, Knock. They basically all stopped operations. And in their case, it makes a lot of sense because their margins are very thin to begin with compared to your investors. They're probably overpaying a little bit in their markets.
Sure.
their holding costs are pretty significant, and you don't know how quickly the market's going to kick back in at the end of this. So buying in large numbers doesn't make a lot of sense if you're going to have to hold them longer. And if there is a dip in prices, you don't want to be sitting on a portfolio of thousands of properties that are overpriced. So I would distinguish a little bit between the fix and flip guys and the buy and hold guys in terms of activity we're seeing in the market right now, and the risk profile. There will probably be, coming out of this, more people interested in renting than there were before this, simply because it's going to take them a little while to get their finances back in order.
Sure.
There are going to be a lot of rental opportunities coming out of this pandemic.
Okay. So with that, I mean, just as we kind of saw, and this is where I started working with Colony American Homes and Two Bridges, et cetera, was back, in 2009 to 2011. Same thing. A lot of people had went through foreclosures, so they were forced to get into the rental market. So rental market started going. So could we see like an inflation in the rental market at the same time as people, like, could we see a similar type pattern?
We could. I mean, household formation has been over 1 million units for the last 2 years. It's getting back to where it was supposed to be. The millennials are finally moving out of mom and dad's house because mom and dad refused to upgrade the Xbox again. So I've done extensive research on this and can tell you definitively that most people prefer to live indoors. So if you're
how do you even say that with a straight face? It just like keep talking, like you just keep talking, just like throw it in there.
Dry sense of humor, Larry. So if you're forming a household and you've just had a hiccup in your income stream, and you'd like the benefits of being in a home but can't really afford it at the moment, you need a little bit more time. Yeah, I could see that. Look, the single family rental market, you mentioned 2009, there were about 11 million units across the country. As of last year, there were about 16 million.
Wow.
So pretty significant. And everybody talks about the colonies and the innovation homes and the American Homes for Rent, the big players. They still only own about 2% of the market. So
really?
Yeah. So 90% of single family rentals are owned by people who own 10 or less properties.
Okay.
And you're in the next tier, which is that 10 to something, and that gets to 95%. So there are a lot of opportunities out there in local markets, and I don't know that we'll see a huge upswell in rental activity, but I do think we'll see some growth, and I don't think you're seeing enough multifamily development to absorb all of it. So I do think for investors, there's going to be some opportunities.
Beautiful, beautiful. Well, if you see me, like I'm checking like 4 different devices and things as things are coming through and stuff here. I don't see any questions and stuff as we're here, but man, is there any closing notes, anything that you want to leave the folks with here as we wrap this up?
Yeah, I guess 2 things. There are opportunities in real estate when markets are going up and when markets are going down.
Right.
And I think the people that are successful are the people that are nimble enough to adjust their business models to take advantage whichever way the market is going. And I don't mean take advantage in a negative sense, but to be there and know what the business opportunities look like. So really important for people to stay attuned to what's going on. Mm-hmm. Again, I'm kind of an optimist by nature.
Okay.
I do think the government has done some unprecedented things to try and cushion the blow for people whose finances have been hit.
Yeah.
And to try and prevent what is a recession from becoming a prolonged recession or even a depression, which could have happened just because of how severe the activities have been to try and mitigate this virus from spreading. Right. So I'm of the opinion that once this thing is more or less under control, we will start to get back to normal fairly quickly. And we'll see a pretty healthy economic recovery, even if we don't get back to 100% right away. So keep the faith. We'll all get through this. Stay home, hug your kids, wash your hands, and life will be back to something like normal before you know it.
We are seeing so here's the thing, right? Like this is like unnormal. We are seeing a lot of beautiful things, right?
Yeah.
You're seeing, again, just like you mentioned, people spending time. I've never seen so many people walking
Yeah.
along our bayou that I have today, interacting with their children, right? Like playing outside. I was looking at some things like in India, you can see the Himalayas like from like you haven't been able to see that because of pollution.
Yep.
Same thing with China, like the Olympic gardens and stuff that are there. You can see it. Wildlife back in Venice, right? Dolphins and swans,
Yep.
like, or in the Venice canals. Like, there's some beautiful things that are happening as well at the end of the day, which is important for people to remember.
You're a coach, so you know this, and you probably tell all your folks this all the time, but there are times like this where you really should be taking advantage of the opportunity to work on yourself.
Man, I've been so like my whole message, right? And this is like from Tom Ferry being a good friend and mentor, and I've been coaching with him, is sharpen the axe, right?
Yep.
You're creating habits now that will last the rest of your life. Are you binge watching on Netflix, or are you picking up, your next book and like developing yourself? Like I can tell you, like my family, like my 3-year-old and 5-year-old are doing yoga with me and then CrossFit with me, and right, and we're doing things and meditation with my 12-year-old, like just trying things. Do we like them? Do we not? And I think I can't like emphasize your point enough. Like, yes, please. If you don't listen to me, listen to Rick, right? Like at the end of the day, work on yourself during this time.
Yep.
Yeah, that's great. Well, man, I appreciate your time today. I appreciate you putting pants on. I know that you guys can't see this, but I was a little worried. Rick was like, do I have to wear pants? I was like, well, like depending where the camera angle is, I guess not. But no, I greatly appreciate it.
That's the big question these days, Larry. At what point do you take off your evening pajamas and put on your daytime pajamas? That's really the question in a work from home society. I'm kidding. Thank you for giving me the opportunity and for having me here for the conversation. I really enjoyed it.
Absolutely. If you need anything, Rick, I'm here for you. Thank you so much. Take care of your family, and I will talk to you soon, sir.